In October of 1929, an estimated $30 billion of stock market wealth was erased in 2 days. In today's terms, that is approximately $500 billion. The breadlines that followed lasted a decade. In October of 2008, $8 trillion of American household net worth was destroyed in a single quarter. In March of 2020, the S&P 500 lost 34% of its value in 33 days, the fastest crash in market history. In each of those events, and in every major financial collapse in between, the story was not just about what went wrong, it was about what held, what sat in certain portfolios, and not only retained its value while everything else fell, but in many cases appreciated significantly, providing the liquidity and the psychological stability that allowed its holders to buy the wreckage at the bottom and build generational wealth when the recovery arrived. That is what this video is about. Not predictions, not speculation. The documented, quantitative, historical record of the three assets that have consistently survived the world's biggest financial collapses. And why, in April of 2026, with the S&P 500 down from its January peak, with a 47.6 consumer confidence reading that is the lowest in 70 years of recorded data, with Moody's recession probability model at 49%, with the Hormuz blockade active, with 4% annualized producer price inflation, and a Federal Reserve that cannot cut rates to stimulate a slowing economy, the case for each of these three assets is not a historical argument. It is a present tense argument built on the same mechanisms that made them work in every previous crisis. I'm going to give you the historical record, the mechanism behind each asset's resilience, the critical caveats that most financial content creators omit because they complicate the clean narrative and the precise reason why the current economic environment is activating each mechanism. And I'm going to do it without recommending any specific security, without telling you what to buy, and without any financial advice. What I'm going to give you is the analytical framework that lets you evaluate each asset on its own merits and decide for yourself whether it belongs in your specific situation. That framework is more valuable than any specific recommendation. Let me show you why. But first, let me give you the context that makes the framework urgent. The world's biggest financial collapses did not announce themselves. They did not arrive with a press release. They arrived after a period of elevated valuation, suppressed volatility, policy complacency, or geopolitical shock that the consensus did not adequately price until it was too late to react without taking significant losses. The Great Depression followed a period of spectacular equity market returns and unprecedented retail investor participation. The 2008 financial crisis followed a period of housing price appreciation that seemed to validate every assumption the mortgage market had made about risk. The 2020 crash followed a decade of the longest bull market in American history, culminating in the highest equity valuations since the dot-com peak. In each case, the conditions that made the crash possible were the same conditions that made the preceding bull market feel permanent. And in each case, the people who had positioned at least a portion of their portfolios in the three assets documented in this video were the people who survived intact, who maintained their purchasing power, and who had the resources to act when the opportunity of a generation arrived at the bottom. We are currently in a period where the S&P 500 peaked at a Shiller-Cape ratio of 39.7, the second highest reading in 150 years of data. Consumer confidence is at its lowest point in the history of the University of Michigan survey. The oil shock from the Hormuz conflict has produced the largest supply disruption in the history of the global oil market per the International Energy Agency. And the Federal Reserve is in a policy trap that prevents it from providing the monetary stimulus that has historically accelerated market recoveries. The historical conditions that activate the three assets documented in this video are present. The historical record says what typically happens next. Let me show you that record. Let me show you the four-stage pattern that determines why financial collapses select their victims and spare their survivors, because understanding the pattern is more important than understanding any specific asset. Stage 1 is the valuation excess. This is the period during which the dominant assets in any given era, whether they are technology stocks in 2000, mortgage-backed securities in 2007, or passive equity index funds in 2026, are priced at levels that embed assumptions about future growth that the underlying economy cannot deliver. At this stage, the three assets documented in this video are typically described as boring or defensive or yielding less than the dominant assets. They are unfashionable precisely because everything around them is delivering double-digit returns and making anyone who holds them feel cautious to the point of foolishness. Stage 2 is the external shock or credit event. This is the trigger that converts the valuation excess from a theoretical risk into an actual crisis. It can be a geopolitical event, a credit market failure, a pandemic, or a monetary policy error. What matters is not the specific form of the shock, but its effect, which is to force the rapid repricing of assets that were priced on optimistic assumptions. At this stage, The dominant assets fall sharply and quickly, often faster than any individual investor can react. Stage 3 is the flight to safety. This is where the three assets documented in this video perform their most important function. As the dominant assets are repricing, investors across every category, from retail to institutional, from domestic to foreign, rush simultaneously toward the assets with the longest documented history of preserving value in crises. The demand surge for these assets in Stage 3 is the mechanism that drives their prices higher even as everything else is falling. And Stage 4 is the monetary response and recovery. This is when central banks and governments respond to the crisis with rate cuts, stimulus programs, and liquidity injections that eventually stabilize the economy and allow a new cycle of growth to begin. The assets that survived Stage 2 and 3 now sit in portfolios that are intact, liquid, and positioned to redeploy into the recovery assets at the moment of maximum opportunity. That is the full cycle, and the three assets I'm about to describe have played Stage 3 roles in every major financial collapse since the modern financial system began. Asset number 1 is gold. Let me give you the undiluted historical record before I give you the nuances, because the record is powerful enough to stand on its own and the nuances are important enough to require the record as context. During the 1973 through 1975 recession, which was driven by the first Arab oil embargo, an energy shock structurally comparable to the current Hormuz crisis, gold appreciated sharply while equities fell 48%. After Nixon severed the dollar's link to gold in 1971, gold surged from $35 per ounce to over $800 by 1980, a gain exceeding 2,000%. During the dot-com crash from 2000 to 2002, the S&P 500 fell roughly 40%, while gold climbed from approximately $270 per ounce to over $310, a gain of approximately 15% at a moment when conventional wisdom said gold was a relic. During the 2007 through 2009 financial crisis, the most instructive modern case study, gold demonstrated both its strength and its critical nuance. It surged 52% between July 2007 and February 2009, the full arc of the crisis. But at the peak of the Lehman collapse in September and October 2008, gold dropped 28% in a matter of weeks before recovering. Why? Because in a severe liquidity crisis, everything liquid gets sold simultaneously. Banks, hedge funds, and institutional investors, facing margin calls, sell whatever they can to raise cash immediately, including gold. The temporary disconnect between gold's long-term value and its short-term crisis price is the most important nuance that most financial content creators omit because it complicates the simple story. Gold did not protect investors who bought at the March 2008 high and sold during the October 2008 panic. Gold protected investors who held through the panic. From the October 2008 low of $730 per ounce, gold surged 78% within 2 years. By August 2011, it had reached $1,917.90, a 163% gain from the crisis bottom. And the Bureau of Labor Statistics documented precisely the mechanism behind that recovery. The PPI for gold increased 12.8% in 2009 alone as the Federal Reserve ramped up its first round of quantitative easing, injecting liquidity into the economy, weakening the dollar, and driving investors who were searching for something that would maintain the value of their total assets into gold. In years when the United States CPI averaged above 5%, which is the inflation threshold comparable to the current environment, gold rose in 7 out of 9 such years and posted an average return of 31%. Compared with domestic equities that fell in 5 of those 9 years and posted an average decline of 0.5%. VanEck's 2025 analysis confirmed that since 2008, gold has outperformed U.S. stocks and treasuries during the most notable market crises, and that in the past 12 months, gold delivered more than double the returns of the S&P 500. Today, in April 2026, the mechanism that has driven gold in every crisis environment is active. Inflation is running at 3.7% headline and 4.8% for one-year consumer expectations, the highest since August 2025. The Federal Reserve is in a policy trap that makes rate cuts unlikely through September 2026, keeping real rates at a level that creates a favorable relative positioning for gold against yield-bearing assets. The Iran war oil shock is the largest geopolitical supply disruption in the history of the global oil market. And VanEck analysis suggests gold has the potential to trade toward $4,000 per ounce in the near term and potentially $5,000 longer term as these structural conditions persist. The nuance is critical and bears repeating. Gold can drop sharply in the initial acute phase of a liquidity crisis before recovering and surpassing its pre-crisis level. It is not a short-term trading vehicle. It is a long-term purchasing power preservation mechanism whose function in a portfolio is to survive the crisis and remain available for deployment when the crisis bottom provides the opportunity that stage 4 recovery historically delivers. Check. Verified. Undeniable. Asset number 2 is short-term United States Treasury bills. And I want to be precise about the maturity distinction because it matters enormously and is almost never made correctly in financial content covering this topic. The Federal Reserve Bank of Dallas published research confirming that in a crisis, when investors prize safety and liquidity, they flock to safe short-term Treasury bills. This was documented as true in both the 2007 through 2009 global financial crisis and the onset of COVID-19 in March 2020. The key distinction is between short-term Treasury bills, which have maturities of 3 months, 6 months, and 1 year, and long-term Treasury bonds with maturities of 10, 20, and 30 years. They are different assets with different crisis behavior. Short-term T-bills performed their safe haven function in both the 2008 crisis and the 2020 pandemic shock, because their prices are largely determined by the government's near-term promise to repay, which is essentially certain, rather than by interest rate expectations over long periods. When short-term yields dropped to near zero in November 2008, T-bill prices rose, protecting holders. When investors needed liquidity and safety simultaneously in a world where corporate bonds were collapsing, T-bills provided both. However, and this caveat is essential, the safe haven function of long-term Treasury bonds is more contested and has shown signs of erosion. In March 2020, long-term Treasury prices actually fell initially rather than rising, the opposite of their expected crisis behavior, as leveraged hedge funds unwound basis trades and foreign central banks sold treasuries to raise dollars. The Federal Reserve only stabilized the market by purchasing $360 billion of treasuries in a single week. Research published on April 15, 2026, by Harvard Business School professor Wengson Du and collaborators documented that the Treasury premium, the extra value investors historically attributed to Treasury securities for their unique safety and liquidity, has essentially vanished from long-term bonds and more recently from short-term T-bills as well. The amount of Treasury debt outstanding reached $29 trillion in 2025, up from $5 trillion in 2008. The flooding of the market with Treasuries has mechanically reduced their special status. This nuance changes the calculus for 2026 specifically. Short-term T-bills, meaning 3 to 6 month maturities, at a current yield of approximately 3.5 to 3.7%, still represent a liquid, government-backed return that preserves nominal capital and provides a real yield that is modestly positive given where the policy rate sits. In a crisis where the Federal Reserve cuts rates to zero and launches new quantitative easing, T-bill prices would rise, and holders would benefit from both the price appreciation and the reinvestment opportunity into higher-yielding recovery assets. But long-term Treasury bonds in 2026 carry meaningful duration risk in a stagflationary environment where yields could rise rather than fall if the Federal Reserve is forced to raise rates to combat inflation rather than cutting them. The lesson from the current research and historical data is precise. Short-term Treasury bills, not long-term bonds, are the instrument that has consistently fulfilled the safe haven function in financial crises. And in the current higher rate environment, they provide that safety function while delivering a yield that was unavailable to short-term T-bill holders in the zero-rate era. The forgotten history of short-term treasuries is that they are not the exciting asset. They are the asset that ensures you have liquidity when every other asset is being repriced at the worst possible moment. That function is more valuable than it appears when markets are calm and irreplaceable when they are not. This is the moment I want to stop and speak directly to you. If this analysis is showing you the historical record for these assets in a way that is more complete and more nuanced than what you normally encounter in financial content, this channel exists specifically for that purpose. Hit subscribe right now. Turn on every notification. Because the upcoming videos in this series are going to apply this historical framework to the specific current portfolio questions that the Iran crisis, the stagflation environment, and the Federal Reserve policy trap are raising for ordinary American investors right now. Protect what you have built. Subscribe first, then let me give you the third asset. Asset number 3 is energy sector equities. And I want to be transparent that this is the most directly tied to the current specific crisis and the one with the most explicitly near-term catalyst, which means it also carries the most resolution risk if the geopolitical situation changes. So let me give you both the historical record and the current data with equal precision. In the 1973 through 1974 Arab oil embargo, which is the closest historical analog to the current Hormuz closure, energy companies producing domestic oil benefited enormously from the price surge, while every other sector of the economy contracted. The S&P 500 fell 48% from 1973 to 1974, while energy company revenues and earnings surged proportionally to oil prices. In the 2022 Russia-Ukraine oil shock, which produced a more modest supply disruption than the current Hormuz closure, the energy sector was the only S&P 500 sector to deliver positive returns, gaining approximately 65% in a year, when the overall index fell 19.4%. In 2026, the pattern is repeating with even more intensity. U.S. News reported on April 15, 2026, that the energy industry is the best performing S&P 500 sector in 2026, up approximately 25% compared with the broader index's 2% gain. Brent crude surged from the low 70s per barrel before the war to nearly $120 at peak, before settling back to the low to mid-90s currently. Goldman Sachs analysts have warned that Brent could average over $100 per barrel through 2026 if the Strait of Hormuz remains restricted. In that scenario, integrated oil majors would generate record cash flows, with free cash flow yields potentially reaching 15 to 20% for the best-positioned companies, according to investment analysis published in April 2026. The mechanism behind energy sector performance during supply shocks is straightforward and has no nuance that qualifies it away. When oil supply is constrained by a geopolitical event, the price of oil rises. When the price of oil rises, companies that produce oil generate more revenue per barrel at essentially the same cost per barrel they were paying before the shock. Their profit margin expands dramatically. Their cash flow surges. They return that cash to shareholders through dividends and buybacks, and their stock prices reflect the earnings upgrade in real time. ExxonMobil and Chevron demonstrated this pattern in the current cycle, both raising dividends while beating fourth-quarter earnings estimates. The critical caveat for energy sector equities is the one that is absent from every other asset in this video. The mechanism that drives energy stock outperformance requires the oil shock to persist. If the Hormuz blockade is resolved quickly, if a diplomatic settlement restores normal tanker traffic through the strait, the oil price premium collapses, and with it, the earnings multiple that the stock market is currently attributing to energy companies. The 2022 Russia-Ukraine analog showed that energy stocks can give back a significant portion of their crisis gains when supply concerns ease. The investor who bought energy stocks at the peak of the 1973 embargo and held through the resolution underperformed relative to the investor who rotated out at the peak and into the recovery assets. The historically informed approach to energy sector equities in the current crisis is therefore to understand them as a crisis hedge that provides genuine inflation protection and genuine earnings power, while the supply disruption persists, while maintaining clarity about the exit conditions and the resolution risks that would require repositioning. Morgan Stanley's March 2026 geopolitical analysis explicitly noted that geopolitical risk is becoming a persistent part of the backdrop, not merely episodic, and that investors should consider increasing exposure around themes like defense, security, aerospace, and industrial resilience, where government spending can drive multi-year demand. That framing is important because it suggests the investment thesis for energy and defense-adjacent sectors is not purely dependent on the Iran crisis persisting. It is also supported by the structural increase in defense spending, the infrastructure investment supercycle in energy transition, and the persistent premium that energy security now commands in a world where 2 consecutive years of major geopolitical oil shocks have demonstrated that supply security cannot be assumed. Here is the final synthesis that ties all 3 assets to the current moment and explains why this video is titled The Forgotten Crisis. The forgotten crisis is not the one that happened. It is the one that is happening. The 3 assets documented in this video, gold, short-term treasury bills, and energy sector equities, have survived every major financial collapse in the modern era for reasons that are mechanistic and repeatable. Gold preserves purchasing power when currency debasement and inflation erode the real value of paper assets, and when geopolitical uncertainty drives the flight to safety demand that inflates its price in the first hours, days, and weeks of a crisis. Short-term treasury bills provide the liquidity and capital preservation that allows investors to survive the initial chaos of a financial shock and emerge with the purchasing power to buy recovery assets at crisis prices. And energy sector equities provide both inflation protection and earnings-driven price appreciation in the specific type of crisis that is driven by a supply-side energy shock, rather than by a demand-side credit event. Each of these 3 assets is currently being activated by the precise conditions that have activated them in every previous major financial crisis in the historical record. Gold is responding to a stagflationary environment, a Federal Reserve policy trap, and a geopolitical shock that is the largest oil supply disruption in recorded history. Short-term treasury bills are providing a 3.5 to 3.7% nominal yield, in an environment where their capital preservation function is more valuable than at any point since the zero-rate era, and their short duration protects them from the bond market volatility that long-term treasuries are experiencing. And energy sector equities are 25% year-to-date in a market where the broader index is down year-to-date, generating record free cash flows, raising dividends, and providing shareholders with the inflation protection that comes from owning the asset that benefits directly from the price of the commodity driving the inflation. The three assets that survived the world's biggest financial collapses did not survive because of luck. They survived because of mechanism. Understanding the mechanism is the most important financial education available in April 2026. Subscribe right now. Turn on every notification. Share this with anyone who has a portfolio they are trying to protect and has never seen the historical record of these three assets laid out this clearly. Because the crisis is not forgotten anymore, you just remembered it. And you now have the framework to act on that memory before the broader market fully prices in what the mechanism has already set in motion. Let me go deeper on the mechanism behind each asset's crisis performance, because the mechanism is what separates informed positioning from wishful thinking, and because the nuances in each mechanism directly determine whether the asset performs its protective function in the specific type of crisis you are currently inside. The mechanism behind gold is the most thoroughly documented and the most frequently misunderstood. Gold does not rise because people panic. Gold rises because panic produces specific, measurable economic responses from governments and central banks that systematically weaken the purchasing power of paper currencies. The sequence is as follows. A financial crisis or geopolitical shock causes economic activity to slow. Slower economic activity reduces tax revenues and increases government spending on stimulus and support programs. Larger fiscal deficits require more government borrowing. Central banks accommodate the borrowing by purchasing government bonds, expanding their balance sheets and injecting liquidity into the financial system. That liquidity expansion, over time, is reflected in the purchasing power of the currency being expanded. And gold, which cannot be printed, borrowed, or politically mandated into existence, preserves its value relative to the currency being debased. This mechanism is not speculative. It has operated in every monetary system since the gold standard was abandoned in 1971 and possibly before. In the 9 years since 1971, when the United States CPI averaged above 5%, gold rose in 7 of them and averaged 31% annual returns. In every recession since 1970 that was accompanied by Federal Reserve rate cuts and monetary expansion, gold either held its value or appreciated significantly. The mechanism is currently running in its most favorable configuration since the post-2008 recovery period that took gold from $730 at its October 2008 low to $1,917 by August 2011. The Federal Reserve has been holding rates at 3.5 to 3.75%. The U.S. national debt crossed $39 trillion in March 2026. Net interest payments have surpassed $1.1 trillion annually, exceeding the entire defense budget. The Moody's recession probability model stands at 49%, and the 4.8% consumer inflation expectation documented in the April University of Michigan survey is the precise psychological condition that has historically preceded the monetary response, meaning central bank easing, that most powerfully drives gold prices. VanEck analysts have explicitly stated that gold tends to outperform during later phases of inflationary cycles when investors seek protection from social, geopolitical, and financial instability. The current phase of the cycle is the later phase. The mechanism is running. The only question is whether any given investor is positioned to benefit from it or is learning about it after the primary move has already occurred. The mechanism behind short-term treasury bills is simpler and perhaps more immediately actionable, but it requires the maturity distinction that I made earlier to be applied precisely in order to function correctly in the current environment. The St. Louis Federal Reserve documented this mechanism explicitly through the 2007 through 2009 crisis, noting that the demand for T-bills was sufficiently large that prices actually rose even as the supply of government securities was expanding at record speed. In August 2008, approximately $1.2 trillion in T-bills was outstanding. By November 2008, that number had almost doubled to $2 trillion, as investors worldwide simultaneously sought the safety of short-term American government obligations. The mechanism in 2026 has a specific configuration that makes short-term T-bills more attractive than they were in the zero-rate era of 2012 through 2021. At approximately 3.5 to 3.7% annualized yield, a 3-month T-bill purchase today delivers more than 3 times the yield available to T-bill holders at any point between 2012 and 2022. That yield, compounded quarterly in a period of elevated uncertainty, provides a meaningful real return in addition to the capital preservation function. And critically, the short duration insulates T-bill holders from the interest rate risk that long-term Treasury bondholders face in an environment where yields could rise further if the stagflation scenario deepens and forces the Federal Reserve to raise rather than cut rates. The Harvard Business School research published April 15, 2026, confirmed that the Treasury premium, the special status that makes Treasuries uniquely liquid and safe, has eroded more significantly at longer maturities than at shorter ones. The short end of the Treasury curve retains more of its crisis function value than the long end. This is the precise nuance that makes the maturity distinction not academic, but financially critical in the current environment. The mechanism behind energy sector equities and supply shock crises is the most direct and the most transparently arithmetic of the three assets. When oil supply falls by 20 million barrels per day, as JP Morgan's commodity strategy team projected occurred by mid-March 2026, as storage filled and bottlenecks persisted, the global oil price rises to ration the reduced supply among unchanged demand. Every barrel that an integrated oil company like ExxonMobil or Chevron produces during the supply shock generates revenue at the shock price, rather than the pre-shock price. The cost to produce that barrel has not changed. The revenue per barrel has increased dramatically. The result is a margin expansion that directly flows to earnings and then to dividends and buybacks. This mechanism requires no assumption about investor sentiment, no central bank action, and no macroeconomic recovery. It operates as long as the supply shock persists. The CSIS Global Energy Markets Analysis, published March 2026, documented that the Hormuz closure created a situation where global supplies were falling approximately 20 million barrels per day short of expected levels, with the IEA characterizing this as the largest supply disruption in the history of the global oil market, U.S. News reported on April 15th that this has made the energy sector the best performing S&P 500 sector in 2026, up approximately 25% year to date against the broader index's minimal gain. The critical resolution risk, as I noted in the main body of this analysis, is real and must be incorporated into any informed positioning in this asset class. The Russia-Ukraine analog from 2022 showed that energy stocks can give back a significant portion of their crisis gains when supply concerns ease. But the current Iran crisis has structural features that the Russia-Ukraine conflict did not. The Strait of Hormuz is physically narrow and militarily controlled in ways that limit the alternatives available to oil exporters trying to bypass the restriction. The naval blockade announced April 13th is a formal military action, not an economic sanction, meaning its resolution requires a formal diplomatic or military outcome rather than a market-driven adjustment. And the IEA's projection that April's supply disruption will be worse than March's, combined with the one-year forward view from Goldman Sachs of Brent averaging above $100, if the strait remains restricted, gives the energy sector earnings tailwind a longer expected duration than the typical geopolitical oil price spike that resolves within weeks. The combination of those three factors, the physical constraint on oil transit, the formal military nature of the blockade, and the institutional projection of sustained disruption, means the energy sector mechanism is likely to remain active for longer than most previous geopolitical oil price spikes. Subscribe right now, turn on every notification. And share this with anyone navigating a portfolio in 2026 who has not yet seen the historical record behind each of these three assets laid out with the nuance and the mechanism that determines whether they protect you or merely appear to protect you until they don't. Here's the final piece of the analysis that puts everything together and explains the title precisely. Why is this the forgotten crisis? Because crises that are building are invisible to the people inside them. The Great Depression was not recognized as a depression in October 1929. The 2008 financial crisis was not acknowledged as a systemic event by the Federal Reserve until Bear Stearns was absorbed in March 2008, 6 months into what was already a credit market crisis that every specialist reading the primary data could see. The 2020 crash was anticipated by nobody in the financial mainstream before February 24th of that year. And the Iran war oil shock of 2026, which the IEA has described as the largest supply disruption in recorded history, is being treated by the mainstream financial narrative as a temporary geopolitical event that will resolve through diplomacy and allow the soft landing story to resume. The blockade is active. The Hormuz traffic is still restricted. The consumer confidence reading of 47.6 is the lowest in 70 years of data. The Moody's recession probability model is at 49%. The Federal Reserve is in a policy trap. The national debt is $39 trillion. Net interest payments have exceeded the defense budget. And the Shiller-Cape ratio at 39.7 entered the year at its second highest reading in 150 years, meaning the starting valuation for any equity correction is the least forgiving in modern American financial history. The forgotten crisis is not one that happened and was resolved. It is one that is being built right now in the data that is available to anyone who reads it without the filter of the consensus narrative that has every incentive to remain optimistic until the moment it can no longer afford to be. The three assets documented in this video survived every previous iteration of this crisis. They survived because of mechanism, not because of sentiment. And the mechanisms are running right now in the current data at the current valuations in the current policy environment. Understanding them before the crisis becomes fully visible in the mainstream narrative is the difference between positioning and reacting, between protecting what you have built and trying to recover what you lost. The historical record gives you the framework. The current data activates the framework. And this channel is where the historical record meets the current data every single week. Subscribe. Every notification. Be here for the next chapter of the analysis. Because the forgotten crisis has not forgotten you, and the three assets that survived the world's biggest financial collapses are telling you exactly what they have always told the people who were paying attention. The mechanism is running. Are you positioned for it? One last point that belongs at the end of this analysis because it is the point that determines whether the framework you just heard is educational or practical. The three assets documented in this video are not abstract. They are accessible. Gold is accessible through physical bullion, through government-minted coins, through gold-backed ETFs that trade on every major exchange, and through gold mining equity funds. Short-term treasury bills are accessible directly through Treasury Direct Gov at no cost, through money market funds that hold exclusively government securities, and through short-duration treasury ETFs with expense ratios that are among the lowest in the exchange-traded product universe. Energy sector equities are accessible through individual stock selection among the major integrated oil producers, through sector ETFs that hold diversified baskets of energy companies, and through dividend-focused strategies within the energy sector that provide yield as well as price appreciation potential. None of these are exotic. None require specialized access, minimum investments that exclude ordinary households, or investment advisor relationships that most Americans do not have. They are the assets that institutional investors, endowments, sovereign wealth funds, and the families that have preserved generational wealth through every major financial collapse in the modern era have consistently held precisely because they are accessible, liquid, and mechanistically sound. The barrier to holding them is not access, it is knowledge. Knowledge of the mechanism, knowledge of the nuance, knowledge of the historical record that distinguishes the assets that merely appeared defensive and the assets that demonstrably and quantifiably protected the portfolios of the people who held them through the Great Depression, through the 70s stagflation, through the dot-com crash, through the 2008 financial crisis, and through the 2020 pandemic shock. You now have that knowledge. Use it wisely. Consult a qualified financial professional about your specific situation before making any investment decisions. And subscribe to this channel so that every time the data shifts, every time the crisis develops a new dimension, every time the mechanism changes its configuration, you are among the first to understand what it means and why it matters for the specific assets that have been protecting intelligent investors for a century. Subscribe. Every notification.